A Liberal Education. Part 1. Corporate Taxes.
One of the least transparent taxes, and one of the ones that I almost laugh at when people talk about increasing, is the corporate tax. When most people say, oh, we're going to increase the corporate tax, it's because we assume that corporations make a whole lot of money, and therefore if we increase the taxes on them, they can often afford it. But corporations don't pay any taxes, and what do I mean by that?
Yes, what do you mean by that?
Well, anytime you purchase a good or service, you're paying a corporate tax. Even though you don't see it on the items you buy when you get your receipt after you purchase something, you're paying a corporate tax. If I go to a store and buy a Diet Coke, I'm paying the corporate tax for Coca-Cola. Why? Well, Coca-Cola decides, well, we're going to lose some money on our taxes. We have to make it back somehow. So we're going to increase the price of all of our goods. And we may even fire some people if it makes us more profitable because of the corporate tax.
All companies pass their expenses through to their customers. This is really basic business and economic stuff, Lee. Take the price of oil, for example. If it goes up, it's more expensive for the tanker to get the product across the pond. It's more expensive to get that product trucked to a factory or distribution center, and it's more expensive to get it to the end user. All through that system, the costs are increased at each step of the pipeline. Here's another example. If I have a company that buys $100 million of computer parts each year and resells them at a 30% profit margin, my company has total revenues of $130 million for that year. As long as all my non-cost of goods expenses total less than $30 million, I now have what are called retained earnings, which I can then reinvest in the form of employee bonuses, construction of a new distribution center, a new marketing campaign, etc., etc. The corporate taxes are just another line item on my expense sheet. Finally, businesses can choose to raise their prices anytime they see fit. Market competitors will continue to apply pressures on both sides of the balance sheet, and of course individual consumers can choose not to pay higher prices. Corporate taxes are one of the main ways in which businesses reimburse a stable society for providing the stability that enables them to stay successful and competitive in the marketplace.
Part 2. Tax brackets and capital gains.
Take, for instance, a housing bubble like we recently had. Anybody who sells a house in San Francisco instantly jumps up to the top 1%. I don't care if they make zero incomes for 10 consecutive years. The second they sell their house in San Francisco during a housing boom, boom, they're going to reach that top 1% bracket because say you sell your home for $1 million, instantly you made $1 million that year, so you jump up into that income bracket of the $1 million mark. You're in the top 1%, you are the wealthiest people, and then the very next year, you're instantly back at the bottom if you weren't even working at the time, even though you accumulated that amount of wealth.
Not necessarily, Lee. If they sold that house for $1 million but owed $900,000 on the mortgage, they wouldn't necessarily be anywhere near the top income tax bracket. Furthermore, capital gains taxes in the United States are calculated based on several factors, the most important of which is the length of time you held the asset. In general, if you held the asset for less than 1 year, any gain you realized by selling that asset is taxed at your ordinary income tax level. If you held the asset for more than 1 year, again, in general, any gain you realized would be taxed at much lower levels. There are various exceptions and special allowances for different types of assets, but the fundamental point is that selling an asset subject to capital gains taxes does not, de facto, change your tax bracket one direction or the other. This is a fundamental fact of the way capital gains taxes work in the United States tax code. You really should know better. Another point that needs to be made is that the changes made to the capital gains rates in the 1997 Taxpayer Relief Act can be said to have helped massively fuel the housing bubble here, because it made it far more attractive to buy and sell real estate, because you were even more likely to retain a fat profit since the capital gains rates were much lower.
Part 3. The flat tax.
Now, in terms of the wonkish solutions that people have to solving our tax code, there are really two that I've seen that are really serious. One is the flat tax, which would be a flat income tax. You get a little index card, you fill it out, any second grader could figure it out. You mark the amount you make on income.
Stop. How do you define income? Is it wages earned? Is it dividends that you've received? Is it interest income? Is it gambling income? Is it gains realized from the sale of assets? What do you mean when you say income? That's the first thing. The second thing, how do you determine the flat tax rate percentage? What is the fancy schmancy mathematics that goes into that calculation?
Just a simple flat tax, everyone pays the same percentage. Now people say, oh my gosh, what would happen if this happened? Well, it turns out many European countries are actually doing this because it's so simple.